And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week, of course. It's Thursday, which also means Michael Leibowitz will join me this morning. We'll talk a little bit about the CPI inflation report yesterday, and did that change any of the Fed's outlook on potentially cutting rates? We'll talk about that, what that potentially means, and we'll look at some of the internals. There was a good bit of talk yesterday about some of the internals of CPI, so we'll get into that as well. But this morning's very interesting, by the way, because right now, going on, if you flip on pretty much any major news channel, you're going to see images of the first commercial spacewalk by SpaceX. So Elon Musk, of course, owns SpaceX, has been building that company for the last several years, doing the first commercial spacewalk in history. And it's very interesting because it's very reminiscent of when I was growing up. I remember the Apollo missions, and we would all sit around, back then it's black and white televisions, to watch the Apollo space missions up in space. So very reminiscent of that to see, this first commercial spacewalk. But kudos to Elon Musk. This is quite the accomplishment for him. I guess, as Brent said this morning, the Tony Stark of our time. Of course, this is, also why SpaceX is probably going to make him a trillionaire at some point. So, because now with a viable commercial alternative to space exploration, there's going to be a lot of potential outcomes from this. So we'll see how this goes. But congratulations to him. Kudos. It's very interesting this morning. Okay, so a couple of things yesterday in particular were happening. So first of all, we had the CPI report out yesterday morning, and came in a little bit cooler than expected. Again, we'll talk about that with Mike here in a moment. But markets sold off on that news yesterday, and really just kind of this correction process that we've been in for a while has continued. But outside of that, we're out of earnings season for the most part. Economic data continues to show signs of internal weakness. Now, again, headlines aren't, overly exuberant, right? But they're not bad, right? We're still creating jobs, for instance, with the latest jobs report. We're still creating jobs. They're not negative, right? We're still creating jobs. They're just slower job growth than we had before. But interesting, the NFIB report came out earlier this week. And the NFIB report, which is the measure of small business confidence around the country, had a very, very sharp reversal. In fact, there is a political bias to the NFIB report because most business owners tend to be lean a bit more on the conservative side because, well, they're running a business. So things like tax cuts, things that help them, reduced regulations, those type of things that typically tend to be on the platform of conservative Republicans in terms of policy mix, is more favorable for small businesses, right? So if you can reduce regulations, reduce, the cost of me doing business, reduce my taxation, those are things that tend to improve the outlook of small businesses. So going into really this summer, there was a very sharp increase in the confidence of small businesses as the odds of President Trump winning the election was improving markedly because, again, that was him running against President Biden. Since the transition now, which occurred about a month ago, that confidence has now dropped sharply because now the race is much tighter. And of course, you now have policies coming from the Harris camp about raising corporate taxes and doing the things that aren't really that beneficial, increasing regulations, et cetera, that will impact negatively small businesses. And this is one of the big facets that, when we look at the economy and how it's structured, these impacts in terms of regulations and taxes, one way or the other, do impact the largest segment of the economy in terms of business. We talk about Apple, we talk about Microsoft. Yes, those are huge companies. but they are a very small number of the businesses that are out there that are actually driving the economy. The small business, non-publicly traded businesses make up a very large chunk of the employment in the country, about 50% of it. So the impacts in terms of regulations and taxes and those things impede the growth of those businesses. And so again, now you can understand why that the NFIB confidence index has a right-leaning or a more conservative-leaning tone to it because of the impacts to their businesses. But the increases in confidence were completely wiped out in the latest report. In fact, we're very close to the historic lows of that index. We closed at 91 on the index, 91.2 on the index earlier this week. The low's about 88.9. So we're not far off from that. And we are very much in recessionary territory in terms of the attitude and sentiment of small businesses. So pay attention to that. I'm going to be touching on that in this weekend's newsletter. So make sure you're subscribed at the website, realinvestmentadvice.com. We're kind of going through some market risk this weekend in that newsletter. So again, it'll be beneficial for you. Subscribe at the website, and we'll have the newsletter out to you on Saturday. All right, let's talk a little bit about the market yesterday. Big reverse. Here's what let me back that up. Let's talk about the markets. Here's what you need to know before the bell. Yesterday we had a big reversal day in the markets. We had the CPI report out in the morning. Came in a little bit hotter than expected on the core side. Markets sold off. We were down about 1.5% on the index. Came down yesterday morning and touched the 100-day moving average after rallying up to the 50-day. So remember yesterday before the bell, we talked about the fact that we were at that resistance level of the 50-day moving average. We had tested the 100-day, rallied to the 50, and we said, hey, this is kind of the make or break moment. If we fail at this 50-day moving average, we're going to continue this correction. Well, yesterday morning, we failed at that 50-day moving average, sold off sharply, 1.5%, came back down, completely wiped out the 2 previous days of gains, touched the 100-day, and then right about that moment, Nvidia CEO was at a Goldman Sachs conference and talked about, they just can't keep up with the demand for AI, and that's all the market needed to hear. The Mag 7 came roaring back yesterday, driving the market up 1%. So we had a 2.5% gain from the low yesterday in the market, a very, very big reversal, and pulled us up right to the 20-day moving average. So we're now testing resistance at the 20-day. So we break above that. The only other resistance is now back to all-time highs. So again, that was a very big reversal. We took out overhead resistance yesterday at the 50-day, retested the 100-day. So very good setup here for the markets. We're also turning the MACD up from a sell signal back towards a buy signal. So if this market can get some follow through today, start really kind of closing this gap on the MACD sell signal, we're going to start to challenge the all-time highs in the markets. Another side of this also is just, we've been building a kind of a consolidation pattern in the market. We did have lower highs that we talked about previously, but we now have rising lows from the bottom. So again, we're starting to compress the market here a good bit. So again, if the market can rally above this and break out of this consolidation, then we'll be back to kind of the bullish trend, and this correctional phase will be behind us. It seems a bit early for that to occur yet because, again, while we did have this correction, we didn't really de-risk the market tremendously in terms of going into the election and potentially for the election outcomes. But that doesn't mean that there has to be more selling. We have been working off some of this kind of that overbought condition that we had previously. We've been through this correctional process. If we do break out to the upside of this, then that correction will be behind us. If for some reason we do fail and break down, of course, we still have some downside risk going into the election. So again, just continue to remain cautious here. That was a very bullish reversal yesterday. Those types of reversals have a mixed bag of indicating either market tops or market bottoms. So again, it's hard to say if that reversal day was the mark of the bottom. Typically, we've also seen these at previous market peaks as well. So let's just be cautious here, continue to manage risk, navigate this market as it kind of goes along. But again, no reason to be overly bearish right now. Technically, the market is improving. That's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Some good questions going on in chat right now. I'm going to try to get to a few of them. We'll talk a little bit about those as we kind of go along. But one of the comments in our chat this morning is right along with our topic, which is basically CPI is a hot mess. So again, there's so many internal things that go on with CPI. And things that happen. There's factors that have a big lag effect. There's other factors that have very little impact on the overall economy because there's such a small weighting in CPI, and so it's there's so many things that are going on with it. And again, as we've talked about before, and this is the most important thing, that CPI is different for everybody. Inflation is different for everybody. What I pay for insurance and what I pay for, food and clothing, et cetera, is different than other people. Not here just locally, but all around the country. In other words, Mike is, as we've talked about before, Mike lives up in Maryland, so things are a lot more expensive for him than they are here in Texas, housing, et cetera. So inflation is different for everybody. And this is, one of the mistakes. And again, we're not arguing the legitimacy of CPI, right? Because CPI has been jiggered and massaged and manipulated over the last 30 years. Actually, ever starting with during the Clinton administration, when he hired the Boskin Commission to come in and recalculate CPI to lower the increase in inflation, to reduce the amount of Social Security payments that have to be paid out. It was to really kind of solve that issue of growing Social Security payments. And so we've artificially adjusted CPI to read lower than what it is in real life. But that's not the important thing. What we're talking about and why you're here listening to the show this morning is how is these inflation numbers going to impact the financial market. So always be sure and set aside your personal, kind of ideas about inflation and what's going on in your personal life, and understand that all the market cares about is just what the official numbers are and how that's going to impact Fed policy. And so, Mike, with that said, yesterday's CPI report came in really kind of in line with expectations at the headline. Core kind of creeped up a little bit because there was an increase in, homeowners equivalent rent. But again, for, homeowners equivalent rent ticked up, which is a huge component of CPI, but food costs went down. So there's offsets, in that CPI report kind of all across the board. So, kind of what was your initial take? And the question, of course, is, does this change at all the outlook for the Fed?
No, it changes zero. The number was very much as the market had expected. Like you said, the monthly core number was slightly higher than expectations, but everything else was right on the screws. The annual year-over-year change in CPI was actually a tenth lower than expectations. But bottom line is, it's what the market expected, and it basically solidifies 25 basis points for the Fed. I'd be shocked if they do anything different than that. I think, though, there is if I'm Powell, a scary component to CPI, and you touched on it, and it's shelter prices. So, shelter prices are roughly 40% of CPI. It's a huge chunk of CPI, and they basically use two different measures to try to calculate both rental and home prices to a lesser degree. And really what they're truly trying to capture are rental prices. And some of it is from rental prices, and some of it is implying it from house prices. And we know in the real world that shelter prices have been, give or take, 0%. Some private industry data shows that it's declining, some shows that it's rising slightly, but either way, it's close to zero. And month after month in the CPI report, it's coming in at roughly 0.5%. And, that gets you 5-6% inflation on an annualized basis. So if you look at the last CPI report, or the one from yesterday, CPI excluding shelter was 0%. It was 0% the month before. It was -1 or -0.2% the month before that. So over the last 3 months, and that's starting to become a good enough time to make some conclusions. There is no inflation except for shelter. So if I'm Powell, I'm starting to get concerned. First of all, if there's no inflation except for shelter, then maybe they should be cutting more. But is shelter so we think, the Fed thinks, Wall Street economists think, almost everyone thinks that shelter prices are going to come down sharply. It's known to lag. It can lag well over a year, and it will catch up to reality. But what if it doesn't? What if it just stays here? Inflation will be slightly higher than normal, but the price of everything else is going to be flat. Maybe even go into deflation. We're going to get oil numbers in a couple months that also lag by a couple months, that are going to weigh on CPI further. So, the Fed's got a little bit of a quandary here. They're going to go 25, but it's going to be interesting because they could wake up to the next CPI report and see shelter prices at 0 and the whole CPI report come in at 0 or even negative. Mm-hmm. So there's a risk that it kind of shocks the market to the downside. And there's a risk that there's just something wrong in the CPI calculation of shelter, and it keeps it elevated more than the true inflation in the country. So, it's something we're going to have to deal with on a month-to-month basis. But the Fed my guess is they're looking into that number and, working with the BLS and trying to figure out why it's not dropping like it should at this point.
Yeah. It's interesting too, because, I've talked about before that, for most people, your health insurance and your rent is a fixed number for a period of time, right? So, and it's interesting, if you strip out those two factors, if you strip out healthcare and housing from the index, inflation's only 1.2% annualized. So it's already below the target. And so for, a lot of people, what will be interesting is when you get to, and we saw kind of that pickup in health insurance earlier this year as all the annual premiums were resetting for everybody, because everybody goes through open enrollment at the end of the year. All your premiums reset at the beginning of the year. And we noticed at that time, excuse me, my nose is itching this morning. We noticed at that time that there was kind of this big pop in health insurance, but that's starting to taper off as that kind of that initial enrollment period is over. So, we're seeing, It's going to be interesting to see because, again, when you kind of look at some of the other factors, take a look at oil prices, which has a very high correlation to inflation. Oil prices have been dropping sharply over the last month or so. And so that's going to feed into this inflation impact as well, because so much of the economy is derived from oil prices at some form or other, whether it's gasoline or the use of oil, whatever it is. It'll be interesting to see how this all feeds in because, again, to your point, it's very feasible that, within the next month or two, you could get a zero print on inflation. If things kind of keep going the way they're going, you get a zero print on inflation, and then the market's going to really start to look at the Fed going, hey, you need to cut faster than you're doing because the disinflationary impact is growing faster than we thought.
Right. And today's commentary, we put out the daily commentary every day. Today's commentary leads with a thing about online prices. So Adobe tracks, just a massive amount of online data. And with it, they calculate they call it their digital price index. So online shopping accounts for, I think it's about 16%, 17% of all of retail sales. And that number is expected to go up. They call it, there are 18 categories, and we have a graph of it in the commentary, but over half are showing declining prices, including grocery stores. Grocery prices fell last month by the sharpest amount since they've been doing it since 2014. Now, the point is, it's only an eighth or so of, maybe a little more than an eighth of prices, but it's what we use to comparative shop. So 3/4 of people go online and shop, and they're doing it all the time. A lot of times you may not buy something online, but you know the price. And then when you go somewhere else, you'll compare that price, and you'll either want a lower price at the store or you'll buy it online. So it's something that sways inflation. Doesn't have a huge effect yet on inflation, but as consumers see that they can get stuff cheaper online, they will either buy it online at cheaper prices or wait for sales or shop it around more so at the stores. So that's also a negative influence that's kind of coming down the pike on inflation.
And that's kind of the case. And we'll see what happens. Again, I don't think the market took really kind of any clues from that number yesterday more than they took from the CEO of Nvidia's comments, about 10 o'clock yesterday morning. That was the big driver. We'll see how this kind of plays out. Again, the Fed meeting is next week, by the way. So next week we'll have a lot to talk about because, again, we'll actually have Powell's outlook and comments. And so next week during the show, we'll talk about what he said and what this all means for inflation. When we come back from the break, a couple of good questions in the chat. We'll get to those, talking about volatility as well. So again, we'll come back, pick up with those after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I remember in school those history stories about the late 1800s, and now Gen Z kids are now calling the 90s the late 1900s.
The Real Investment Show podcast.
And I feel like I just drank from the wrong grail in Indiana Jones.
Same show, your schedule.
I was talking to my daughter a few weeks ago, and I said something that she didn't agree with. And she goes, "Dad, you're just getting old and not relevant anymore."
At realinvestmentadvice.com.
Not relevant.
You're not relevant.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Mike Lee was joining me, of course, as we kind of get through a couple of good questions in chat this morning. One was talking about volatility and a volatility ETF. There's a lot of these ETFs that are out there that track volatility. The question in particular is SVOL, which is the Simplify ETF for tracking volatility. We have examined these before in the past because, we understand volatility, we track volatility, it's part of our analysis, and there's times where there's kind of some obvious entry points for going long volatility or going short volatility in terms of investment hedging, etc. And the ETFs in general have never worked well. We've tried them numerous times, and you just don't work well. They don't work well for a lot of reasons, and a lot of it is because of the optionality of the underlying options. For us, the only thing that's ever worked halfway well is actually buying the options on volatility. But Mike, you and I have had these conversations. I can't tell you how many times. There's kind of two big factors that come down to trading volatility. One, you've got to be spot on with your timing in terms of trading volatility. But the other side of it is and to the conversation, to the question in particular, is the problems with the underlying ETFs.
Yeah, they're flawed products. I think the really only time that people that aren't just options experts, professionals that are trading options, should play around with volatility is when it's either very low and you want to either go long it or you want to buy options, call options on it, or when it's very high and you want to short it. Now, there's flaws with each one. If it's very low, it can stay very low for a long time. And as you'll see, as your time decays and volatility can continue to go down even at low levels, the option value goes down. So those long volatility ETFs or calls will go down in value and you'll just slowly bleed out. Now, conversely, when volatility is very high, it's proven in the past to be a great chance to short volatility. And that's great. Again, if you nail the top, that's wonderful. But volatility begets volatility. And you may think we're at the top, but volatility can go up, you talk about numbers like in stocks going up 5-10%. That's a big day. In bonds, we're talking 1%, 2%. Volatility can double or triple. We, in fact, when was that? Volmageddon. I forgot when that was. But there was a short. When was it?
August
No,
the
there was
5th.
one a few years ago.
Oh, a few years ago, because we just kind of had one just back on August the 5th.
Yeah. Well, even that. But there was one pre-COVID, I think, where one of the shortfall ETFs went under because it went to zero. And, it's the problem is that you could be short something and the thing you're short can double or triple. And then ultimately 3 days later, go down below where you shorted it, but it could be too late. You could get more margin called. You could just freak out and get out of it. Or the shortfall ETF could just go out of business because it goes to zero.
Right.
So, we'd advise, and we take this own advice, that if you're not a skilled options trader, it's probably best to watch, pay close attention to implied volatility. But it's a very difficult product to gamble in. Well, and I do say gamble, not invest.
It is, and look, and like I said, full disclosure, we have a portfolio that that we use options in, and and it's just a great example of volatility and how it works. But we actually bought call options on volatility late July. And, we watch it very closely, and we had, the market started to correct because we were expecting that correction, and volatility was extremely low. So we bought these call options on volatility, and we had a nice gain in them. The volatility was ticking up, the market was coming down, and, and the problem with this is that the price can, you can have volatility one day and the next day the market rallies and volatility drops like a rock. So when you're trading options, you've got to nail that timing just right. And so we had a nice gain in our options. We sold them, we took the gain, and we felt really, really good about ourselves. We were like, man, we nailed that one. That was a good trade. And then we woke up Monday morning and volatility kind of shot through the roof because that was when the yen carry trade blew up. So we missed it by a day. But, and this is the problem with options. And to Mike's point, just a great example with options is that they have an expiration date to them. And, I always tell this one story, which is, back in early 2000, late 1999, early 2000, I bought a ton of put options on Intel. Now, Intel was the Nvidia of the late 90s, right? So, it was just going to the moon because it was semiconductors and the whole world's going to be, just doing fantastic. And I bought put options, and the put options expired on the third Friday of February. And I was like, I've got this nailed, this market, because of where things are, it's going to correct, blah, blah, blah. And unfortunately, the correction came a month later. Right. So my options expired in February and the market fell apart in March. So just, time, that's what I mean by timing, is that you can have the right thesis, but the problem with options in general is that if your timing's wrong, everything goes to zero. And this is the problem with these ETFs, is that inside these ETFs, these options are constantly expiring, and Mike and I look at this on a regular basis, but these options are constantly expiring and having to be renewed, and you have this time decay of premium with options. There's some complexities that go on with options, but when they're inside of an ETF, this is all happening inside the ETF. So it's slowly bleeding away your principal over time because of that. And so you have to buy the ETF. If you're betting on volatility to spike, you almost have to time the volatility spike with the ETF, just as if you're buying an option. You've got to trade it almost the same, because otherwise, if you just hold it, that bleed of optionality will just continue to erode your principal or erode your return relative to what volatility is actually doing. And all you got to do is take a look at, take an ETF and overlay volatility on it on a chart, and just go back and look at August, and you'll see this massive spike in volatility, but you'll just see a very small gain in the underlying ETF, and that's the problem that occurs. Mike, any comments?
Yeah, I was going to say, I've actually heard on the short volatility side, because I think that's the more popular,
right?
Because volatility tends to decline and stay low probably 80-90% of the time. So there's a lot of hedge funds do short volatility. A lot of retail investors also are short volatility via ETFs. And I've heard those type of funds or short volatility compared to the life of a turkey. Every day's great, right? They're around their friends, they're getting fed. There's a big fence, so they don't have to worry about the fox or anything attacking them. Every day's great, one day after another, and then it's Thanksgiving and it's off with their head. And that's the short volatility trade.
Right.
It could be great for a year, but it's always going to be Thanksgiving.
At some point. That's great. No, it's great. That is such a great analogy. That's awesome. Real quick, one other question I thought was a really good question in our chat this morning was talking about sanctions on semiconductors. Obviously, semiconductor stocks have been the big trade, this year in particular because of AI. Yesterday as well, because of comments from the CEO of Nvidia. But this is something important about policy, and I just put this out on X this morning, Twitter, whatever it's called these days. But I put a chart out of two policies, right? So they did budget analysis or deficit analysis of Trump policies versus Harris, and it's very interesting because what they look at is they say, okay, well, Trump is going to put tariffs on China. AKA, we're going to put, kind of work on controlling semiconductors as an example, but other products coming in from China. So we're going to put tariffs on that. That's going to create revenue, right? And then they do the analysis of, well, he wants to do tax cuts for corporations. He wants to eliminate tax on Social Security for individuals. He wants to eliminate tax on, businesses, et cetera. Reinstate the personal tax cuts from 2017. Or extend those, rather, they're still in effect, but he wants to extend those. And so those are all deductions, right? So in theory, those tax cuts are going to, offset the revenue brought in by the actual tariffs. So over 10 years, according to this analysis, it's going to increase the deficit by $3 trillion. Harris, on the other side, her policies is that she wants to raise taxes, which is going to create revenue, but then she wants to do a lot of social spending. So her policy prescription will only increase the deficit by $1.5 trillion. So clearly, it looks like there's this offset. Now, what does it have to do with semiconductor tariffs? Well, we'll come back and talk about the impact of that, but what is important to distinguish when you talk about policy, you have to go one step further and look at the impact on the underlying economy and the revenue that is generated from economic activity. We'll pick up with this with Michael Leibowitz on the other side of the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just for the break, kind of pushing two topics together. One is tariffs on semiconductors, of course. This is, part of the kind of Trump policies, more tariffs on China, tariffs on semiconductors, et cetera. The goal there is to bring more manufacturing back to the U.S., right? So to avoid tariffs on imports. We import a lot of semiconductors from Taiwan into the U.S. In fact, Taiwan Semiconductor is one of the biggest producers of technology, et cetera, for building semiconductors on the planet. So, I mean, they're huge. And we import a lot from Taiwan. So in theory, right, the idea of tariffs is that to avoid that tariff, we bring more manufacturing back to the U.S. It's not really the way it works, but that's the idea. We just simply find another low-cost producer somewhere else, move a plant somewhere else to produce the chips to avoid the tariffs. But, those have impacts to the economy. And this is why I was talking about policies in general. And there was, this analysis has been running around for the last couple of weeks, ever since, heading into the debate this week and talking about, Trump wants to impose, I'm going to read this real quick. He wants to impose a 10% universal and 60% increase on Chinese tariffs. Okay, so that will bring revenue into the government, right? So the tariffs have to be paid. That's a tax. That's revenue for the government. He then wants to lower the corporate income tax rate to 15%. It probably won't get done. It'll be at 21. Extend tax benefits, eliminate taxes on Social Security benefits for individuals, right? So in other words, if you're working and getting Social Security, you won't have to pay taxes on the Social Security, and extend the tax cuts from 2017. So those are all negatives to that revenue, right? Because all of a sudden, if I do tax cuts, that means the government is collecting less tax revenue on income, right? So in isolation, yes, that increases the deficit. Harris, as an example, on the other side of that, her policy is that she wants to raise the corporate tax rate to 28%. That increases revenue to the government. Reduce drug costs. That increases. Have other tax increases, also bringing in some other revenue. But then she wants to do, down payment support for housing. That's an expense. Tax credits, social care agenda, expanded child tax credit, and extend most income tax cuts to some degree. So that's all increasing spending. Okay. So her policy prescription, because of what she wants to do, won't increase the deficit in theory as much. Now, here's the problem with all of this. None of this analysis includes what the impact is on economic production. Because if I have a policy that increases economic activity domestically and increases revenue for those companies, even though I have a lower tax rate, they pay more taxes, right? Because you have increased revenue coming in. So none of these policy analysis account for the impact on economic activity. Does it create stronger economic growth that creates more revenue on which taxes are collected? In other words, I may have a smaller percentage of tax collection on a much bigger pie, right? I can have a large tax collection on a much smaller pie, and you can figure out the math from there. So, the question that you really have to ask yourself is, looking at these two proposals, which one potentially increases economic activity more, those of Trump or those of Harris? Mike, comments?
Yeah, I just think it's impossible to try to figure out which one will be better for the economy. And, some of their proposals follow each other. There are some similarities as well. I've been writing about the corporate tax proposals from both candidates. I'll try to get that out for next Wednesday. But bottom line is, Trump wants to reduce taxes to 15% from 21%, but only for companies that make goods in the U.S. Harris wants to raise the rate from 21 to 28, which is a 7% increase, but still below the 35 that Trump dropped it from in 2017. So the question is, which one is better for the economy and for the federal deficit? And it's very easy to say, well, Harris is going to raise the rate from 21 to 28. The government's going to collect more money. That's great. And she's going to raise the buyback tax in theory, according to her proposal. That's great. The government's going to raise more money. But let's go back to Elon Musk. If Elon Musk is now paying an extra his Tesla and his other businesses are paying, Starlink are paying an extra 7% in taxes, that's 7% that he doesn't have to innovate. Now, some companies
or to hire with, or to provide, pay raises, etc.
Right. But I use the word innovate because innovation and productivity are what ultimately drive the economy. So if he can invent the next electric car, the next, you name it, he can just create so much economic growth that'll more than offset that tax rate. But if he has to pay more taxes, he has less money to innovate. Now that's one side of the story. The other side of the story are companies that are making a lot of profits, paying their executives a fortune, and buying back stock with their money instead of innovating. So I think what we really need is some creative tax cut, tax increase that is based on how much productivity they can provide the economy. Can they innovate, or are they just spitting out money to executives and sharekholders? And
well, that's an easy fix, right? And that's even been proposed, which is simply tax corporate buybacks, right? So,
well, and that's
because
right.
Again, the only people that benefit from corporate buybacks are insiders. So if you take away that incentive, the only reason companies buy back their stock is because they're not innovating. To your point, they're not innovating. They're buying back their shares because there's not a better opportunity or use for that capital. R&D,
right,
et cetera, is expensive. It's costly. It takes time to generate a profit on. So if you slap it, so yeah, you cut the corporate income tax rate to 21% or 15%, whatever the number you want to have it at, but then tax your corporate buybacks at 28 or 35%, all of a sudden that incentive to do buybacks goes away very quickly.
So that Harris's plan, there is a 1% buyback tax, and she wants to bring it to 4%. But I think what's interesting about 4% is that's above all the dividend rates. Mm-hmm. So it now makes paying dividends probably a little more rewarding than buying back shares. And
I'm all for that, right? Because again, if you're paying out dividends, actual dividends, those actually go to your shareholders. So every American that owns, General Electric stock or, whatever company you own, Procter & Gamble, that pays a dividend, that's income going into that household, which gives them money to spend in the economy. And again, the whole point here is what policies generate more economic activity. Well, if you put more money in people's pockets, they will spend it. Proof in the pudding was sending $1,500 checks to households. They didn't save that money. They went out and spent it. And so if you, anything that you do, and look at the growth rate you got in the economy from those checks, you had this massive surge in economic activity because you gave people money to spend. So if you, any policy that you do, look, eliminating tax on Social Security benefits for individuals, people in their 60s or 70s, they have to work. And if they're being taxed on their Social Security on top of that, that makes them less inclined to work in their older years because they're trying to not get above that $30,000 a year income so they don't have to tax their benefits. But that's reducing productivity in the economy. People are living longer. They want to work longer, but they can't because of their Social Security, and they're dependent. 80% of Americans almost solely dependent on Social Security. Remove that tax. That's more money for them to spend in the economy on their grandkids, taking, traveling with their wife, whatever it is. But that helps economic growth. So again, those are we have to look at policies in terms of what is the ultimate impact on the revenue generated from activity in the economy.
And the problem is you have this broad swath, right? Everyone pays 21%. Every corporation pays 21%. But there's very different types of corporations. And again, if you take an innovative company, we'll go back to Elon Musk, he can, if you lower his taxes, his benefit to the economy is potentially much greater than Apple. Apple is just going to buy back more shares and invest in its executives. So you need, what we really probably need is some tailored approach to our tax code that is what neither candidate is really offering. Tariffs may be part of it, and various incentives or disincentives within the tax code. But you don't really hear any of that. You just hear we're going to bring them up to 28% or down to 15%. Just again, it's the broad swath. You're just changing the percentage. And
right.
I think that
and look, and you've done the analysis. I've done this analysis before. Corporate, the corporate tax rate may be 21%. The effective tax rate that corporations actually pay is about 15%.
I just ran. It's 13%.
There you go, 13 so,
on average.
Yeah.
And there are many companies with a negative tax rate, which means that they're actually getting money back from the government for various reasons.
Right. But again, it's that's the tax code. And again, if we want to, and this is the whole myth of, high net worth people paying their fair share. High net worth, the top 10% of income earners, top 20% in particular, pay 90% of the taxes. So exactly what's the fair share if 20% of Americans are paying, 90% of the taxes? There's the problem you have to fix is not the tax rate. You've got to fix the tax code. And nobody's ever going after fixing the tax code, which is if you really want a more balanced, equitable tax system, you've got to fix the tax code, not just change effective rates.
And if you want to do that, you got to change corporate donations to politicians.
There you go.
And that's a whole different problem.
That's a conversation for another day. All right, that wraps up the show for the day. Thanks for joining. Tomorrow will be Danny Ratliff, Richard Rosso here on the show in the morning for Financial Fitness Friday. Our newsletter this weekend will be talking about market risk in particular. We're laying out 3 different market risks in this weekend's newsletter. So make sure you subscribe to the website, realinvestmentadvice.com. Also, be sure and like and subscribe to the channel. We certainly appreciate it, and that helps us do the show every day. So the more you help, click that like button. We appreciate it, and we'll see you back here tomorrow.